The United States has stepped into the Japanese yen market, but this is not the first time that America has supported the yen. So, when has the US intervened in the yen? Why does America care about Japan's currency? And can this intervention actually make yen stronger? Hi, welcome back to Corporate Lens. Let's cover this entire story together. When has the US intervened to support the yen? The first major episode was in 1985, the Plaza Accord. The United States, Japan, West Germany, France, and the UK agreed that the US dollar had become too strong and other currencies, including yen, should strengthen. The countries coordinated interventions by selling dollars and buying other currencies. But why? Because an excessively strong dollar was hurting the US exports and worsening America's trade imbalance, while Japan's very competitive exports were becoming a major political and economic issue for the US. Then came 1998. In June 1998, the US sold dollars and bought about $833 million worth of Japanese yen, coordinated with Japanese authorities. Now, this is important because in 1998, US buys yen, and today, after a gap of almost 3 decades, in the late August 2026, US again buys yen. Then came in 2024 when Japan intervenes on its own. The yen became extremely weak in 2024 and Japan had to intervene itself. Japan sold dollars and bought yen. So Japan spent enormous amounts of its reserves trying to strengthen the yen. So what is happening now in 2026? The yen fell to around 164 yen per dollar, a multi-decade low. This made Japan increasingly concerned about the inflationary consequences because of such a weak currency. Hence, in late July or early August 2026, Japan and the US coordinated action to support the yen. The US has intervened in the yen currency market recently by selling euros from its international reserves and buying the Japanese yen. This intervention has helped push US dollar Japan exchange rate down from around 164 yen per dollar to around 158 yen per dollar. But here is the big question. Why does the US care if the yen is weak? Because the yen is not just Japan's currency. The yen is deeply embedded in the global financial system. Japan is a massive investor in the world. Japanese institutions and investors own enormous amounts of foreign assets, including US treasuries. So, if the yen becomes extremely weak, Japanese investors could sell foreign assets and bring yen back to Japan. As a result, global bonds yields rise and global markets become volatile. So the US does not want this uncontrolled yen crisis. The bigger problem, the yen carry trade. For years, Japan had extremely low interest rates. Suppose Japan interest rate is 1% and US interest rate is 4 to 5%. In this case, an investor could borrow cheap yen, convert yen into dollars, then buy US bonds and stocks and earn the higher return. This is called yen carry trade. But there is a catch. Imagine you borrow 100 million yen. When you borrowed it, $1 was equal to 150 yen. So 100 million yen is roughly $666,000. Later, the yen suddenly strengthens and becomes $1 equals to 130 yen. Now you need more dollars to repay the same 100 million yen. So the investors start selling their dollar assets and buying yen to repay the loan. And that creates, with more yen buying, the yen strengthens, the carry trades unwind, and it results in more yen buying. So the yen can affect the entire global financial system. But what does a weak yen specifically mean for the United States? Well, it's negative for US manufacturers. Suppose Japanese car is equivalent to 5 million yen. If $1 equals to 100 yen, so that car costs roughly $50,000. But if $1 depreciates to 160 yen, then the same 5 million yen car costs only $31,250 for an American buyer. So Japanese products become cheaper relative to American products, and that can hurt American manufacturers. However, cheaper Japanese goods are good for American consumers and for US companies importing Japanese components. So the effect is not universally negative. So, what does a weak yen do to Japan? Well, the good part is that Japanese exporters become more competitive. For example, Toyota sells a car overseas and receives dollars. When those dollars are converted into yen, the company gets more yen, so exporters can benefit. And the sad part is that Japan imports enormous quantities of oil, energy, food, raw materials, and they are generally priced in dollars. So when the yen weakens, imports become expensive and Japan inflation rises. And that's exactly why Japanese businesses are increasingly uncomfortable with the yen nearing 160 to 164 yen per dollar. So how can the yen become stronger? Well, number one, if Japan raises the interest rates. Suppose Japan's interest rate hikes from 1% to 2% and US interest rate shrinks from 4% to 3%, the interest rate gap shrinks. Suddenly, borrowing yen is not as attractive. So, when the demand for yen rises, the yen strengthens. Well, secondly, if the US cut interest rates. If the US cut rates while Japan rates increase, the gap between them becomes smaller. And this reduces the incentive to borrow yen and buy dollars. So if the dollar demand goes down, the yen demand goes up and the yen strengthens. Third is the Japan intervention. Japan can literally use its foreign exchange reserves to sell dollars and buy yen. That creates immediate demand for yen. But you cannot permanently fight economic fundamentals with foreign exchange reserves. So the fourth one is if the Japanese investors plan to bring money home. Japanese pension funds, insurers, and companies, if they decide to sell foreign investments and convert back dollars into yen. So this creates a system like if the dollars are sold, yen is bought, the yen automatically strengthens. So, before we answer whether yen can stay strong, let's look at Japan's macro snapshot as of August 10, 2026. So, Bank of Japan policy rate is at 1%, Japan inflation is around 1.7, unemployment is at 2.5%, then 10-year Japanese government bond yield is around 2.8%, but the US policy rate is still around 3.5 to 3.75%. So, look at the picture. Japan has finally moved away from its ultra low interest rate era. Its labor market is tight, wages are improving, but inflation is currently or slightly below Bank of Japan's 2% target. The household consumption remains relatively weak. Well, Japan's government debt is also enormous, which makes aggressive rate hikes difficult. So, Japan is caught between two forces. It needs higher rates to support the yen and control inflation, but raising rates too aggressively could hurt growth and increase the government's debt servicing burden. So, this is exactly why the yen's future is so complicated. Can Japan and the United States change the economic forces that have kept the yen weak for years? Well, the intervention can change the direction of the currency temporarily, but to change the long term trend, the fundamentals have to change too. And that is what will determine where the yen goes next. I hope you find this video informative. Thanks for watching.